Welcome to our YouTube channel, Get Invested. I'm James.
And I'm Felix.
We are enthusiastic investors in the stock market and we're keen to share some of our knowledge.
We're young professionals in the software industry and realized that in today's workplace, most of our colleagues and friends don't know how to invest their hard-earned cash.
Myself and Felix work together in Ireland. As you can tell from our accents, I'm from the UK and Felix is German.
But we still get along most of the time.
So anyway, we came with the idea of this channel as more and more of our colleagues at work were interested in hearing about our investments. So we started this channel to help others learn why, how, and where to get invested.
We are certainly not financial advisors, so we encourage you to do your own research as well. In this video, we are going to show you why you should get invested.
So Felix has an example he's been dying to share with you, which isn't possible in real life, but it will give you a good understanding of how investing can be rewarding.
So imagine you have a cent or a penny and it would double every day. How much do you think you would have by the end of the month?
When you asked me this a couple of weeks ago, I initially thought around 1,000.
But as you know now, you reach the 1,000 mark at day 18. By day 28, you're well over 1 million, and if you're lucky enough and your month has 31 days, you will reach the 10 million mark within that month. Is that what you thought? Probably not.
Okay, so now let's look at a real life example. Most people, including myself, can't start the morning without at least one coffee. Let's see what you could save by enjoying your morning coffee at home.
So a coffee is typically between 3 and 3.50 in pounds, euro or dollar, depending on where you live. Let's look at how much this could add up to if you invested it.
So in New York, a cup would likely be $3.50. This would add up to $105 a month, which equals $1,260 a year.
If your coffee a day is saved and invested for 30 years at an average 10% annual return, you would end up with a whopping $217,000.
Keep in mind, by getting to this number, you would only have invested $37,800 of your own cash, and the rest is compound interest. So now we've shared a couple of examples. Here are 5 common reasons why you and I should invest.
For your retirement, to be independent and not rely on others. Or for your kids, to give them the best start in life. Or for property, to be able to own your dream house.
Or maybe you'd prefer to invest so you're able to travel the world and complete your bucket list. Or for financial freedom, so you're able to spend all of your time doing what you enjoy the most. Achieving these goals is a lot easier when you give yourself more time. Some of the most successful investors in the world live by the rule, it's time in the market, not timing the market. My first investment was an index fund. I believe this is a great way to get started as it gives you the possibility of investing in many different companies at the same time. An index is simply a collection of different companies, also called stocks.
I prepared a chart to highlight some major stock indexes compared to an average bank interest rate during the last 30 years. For this example, we compared the MSCI World Index, which consists of stocks around the world, the S&P 500, which is solely American stocks, and the Euro Stoxx 50, which consists of European stocks. As you can see, the global stock market has an upwards trend, even with some years of volatile dips.
You can also see the European index isn't at its highest point in time, which shows you that putting all your money in one index or stock isn't wise.
If you look at the green line, this is the bank interest rate. You will see that in the long run, the stock market was more profitable. Therefore, if you are committed to a longer-term investment strategy, your money will most likely grow with the market.
You can further decrease your risk by investing your money on a regular basis. This has 2 major benefits. Firstly, you don't need a lot of money to get started, and secondly, you'll benefit from the cost average effect.
The cost average effect enables you to reduce the investment risk by investing the same amount of money over a long period of time. This means you will be buying the same stock or index at different prices. This eliminates the risk of investing at the wrong time and gives you a long-term average cost of your investment.
With all this in mind, a recurring investment over a longer period of time will be the safest way to get invested. Personally, I like to invest straight after payday on a monthly basis. This way, I know what I have left to spend.
And you can enjoy the rest of your month knowing you already invested in yourself.
If you like this video, please give us a thumbs up and subscribe to our channel to be the first to see our next video.
Coming up next, how you own a part of a company by investing.
See you next time.